You are watching Market Pulse Daily. Today is Friday, May 29, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. SpaceX IPO valuation slashed amidst tech correction fears. Today's agenda: tech IPO correction, geopolitical oil shock, crypto's bifurcated outlook, gold's neutral stance, agentic AI and blockchain. First up, a major shockwave from the tech IPO market. SpaceX has just slashed its IPO valuation target. It's down from $2 trillion to about $2 trillion. This comes after they reported a massive about $4.9 billion loss in the first quarter of 2026. Revenue was about $4.7 billion. This is a big deal. It shows investors are starting to demand profitability, not just hype, especially with SpaceX carrying significant debt. This IPO needs to go well. We're seeing a clear shift away from just paying for the Elon premium. Investors are now preferring profitable AI hardware over speculative space ventures. This could mean a broader cooling of risk appetite for tech stocks. Watch other upcoming tech IPOs very closely. The pricing of SpaceX itself will be a key indicator. As always, keep an eye on gold and silver as traditional safe haven assets, and on Bitcoin as a faster moving indicator of liquidity conditions and risk appetite. Now let's turn to the simmering geopolitical situation in the Middle East. Geopolitical tensions in the Middle East are once again front and center. Iran is reportedly weeks away from weapons-grade uranium. The big fear here is a closure of the Strait of Hormuz. Analysts are warning that if that happens, oil prices could skyrocket to about $150, even about $200 a barrel. This would be a massive supply shock. It would absolutely reignite inflation globally. That means central banks might have to keep interest rates higher for longer. The US dollar would likely strengthen as investors seek safety. Right now, WTI crude is trading around about $75 to about $80 a barrel, but the market might be underestimating this risk. We need to watch the Strait of Hormuz status very, very closely. Any news from that region will be critical for oil prices and inflation expectations. The dollar remains a key variable here. A stronger dollar tends to compress commodity prices and weigh on emerging market assets, while a weaker dollar does the opposite. Now let's look at how these macro shifts are impacting the crypto market, PA. Bitcoin is in a really interesting spot right now. The medium-term outlook is split. On one side, we have strong demand coming from AI infrastructure and Bitcoin-backed lending. That's creating a solid floor, but short-term, it's vulnerable, especially with potential liquidity shocks from that Middle East energy crisis we just discussed, or if speculative tech stocks start to really unwind. If oil prices spike, Bitcoin might dip initially as investors pull back from risky assets, but then it could reassert itself as a hedge against inflation and currency debasement. Right now, the crypto fear and greed index is at 23 out of 100. That's extreme fear. This is a divergence from Bitcoin's price, which is holding around about $73,400. Watch that about $71,000 to about $72,000 support level very closely. Real yields are worth watching closely. When real yields rise, growth assets like stocks and crypto tend to struggle. When they fall, hard assets like gold tend to benefit. In contrast to the volatility in tech and crypto, let's look at gold. Gold is trading around about $2,300 an ounce, and it's been a volatile session. The recent pullback isn't necessarily a sign that gold's bull run is over. Instead, analysts see it as healthy consolidation. Governments are actually selling gold reserves to raise cash for their deficits and to help consumers. So gold is acting as a liquidity source. At the same time, the world is increasingly looking at gold as a neutral settlement asset. This means it's being used for commodity trades outside of the US dollar. This is a big deal. It supports a long-term bullish case for gold. We're seeing a two-speed economy. AI spending is driving inflation, but consumers are struggling with falling incomes. Gold is a key hedge against this. Watch for any further liquidation by governments. Also, keep an eye on that about $4,100 level if the oil crisis really heats up. From a cross-asset perspective, the relationship between equities, bonds, and commodities is telling us something important about where institutional money is positioning. Finally, let's look ahead at the transformative potential of AI and blockchain. Looking ahead, the convergence of AI and blockchain is set to be truly revolutionary. Yatsu is talking about agentic AI, which could bring a 1,000-fold increase in productivity. Imagine autonomous AI agents managing tasks and trading with each other. This creates what he calls ghost GDP value generated purely by machines. And the key infrastructure for all of this, blockchain. It's essential for digital identity, trust, and secure transactions between these AI agents. This is the future of Web4. The market is still in its early internet phase, so broad diversification across AI and blockchain companies is key. We're seeing a shift from speculative NFTs to real utility in these Web4 applications. Crypto assets are becoming the foundational rails for this new economy. Watch for the integration of AI into blockchain and the development of new agent-discoverable protocols. In the options market, implied volatility is a useful gauge of how nervous or complacent traders are heading into the next catalyst, worth monitoring if you trade around events. Today's report highlights a market at crossroads. The enthusiasm for AI and blockchain is undeniable, but immediate geopolitical tensions and potential liquidity crunches in private credit are creating significant short-term risks. Investors are advised to navigate this environment with caution, focusing on resilient assets and understanding the potential for sharp price swings. Thank you for your attention, and we will see you again tomorrow. For longer-term investors, the macro backdrop matters more than any single day's move. Focus on the trend in central bank policy, credit conditions, and earnings momentum. On the geopolitical side, supply chain dynamics and energy flows remain underappreciated drivers of inflation and corporate margins in the current cycle. Central bank communication will be closely watched in the sessions ahead. Any shift in language around inflation, growth, or the pace of policy normalization could move markets quickly. Energy markets are closely tied to global growth expectations. Oil and gas prices often move ahead of broader economic turns, making them a useful leading indicator. The credit market is worth watching here. Investment-grade and high-yield spreads can signal whether institutional investors are becoming more cautious about the economic outlook. Emerging market assets tend to be sensitive to dollar strength and global risk appetite. A strong dollar combined with rising U.S. yields can put pressure on both their currencies and bonds. Seasonality patterns in equity markets have historically shown certain months outperform others, but macro conditions this year are the dominant driver, not the calendar. As always, keep an eye on gold and silver as traditional safe haven assets, and on Bitcoin as a faster-moving indicator of liquidity conditions and risk appetite. The dollar remains a key variable here. A stronger dollar tends to compress commodity prices and weigh on emerging market assets, while a weaker dollar does the opposite.